and welcome to today's video, which is called Risk on Squeeze in S&P 500, but yes, exactly, because there are a couple of mixed signs that I need to examine and present my take on these, as these would be driving the price action in the hours and days ahead till FOMC. So let's dive right into it. Such was the situation Monday pre-market. Sunday bearish gap, as I called for it to be so. However, then predicted as well poor retail sales, poor manufacturing data, causing equities to go on rallying for a second day in a row, which was following prior whipsaws what we captured with clients, whether swing or intraday. How the situation changed looking at today pre-market. We had seen as well the retreat after getting out near the intraday highs. Is this a downswing rejection on this hourly that you see, or is there going to be more probing to the downside below, say, 5,700 even? On June contract, June futures contract. Such is the situation in S&P 500. Nasdaq, are we seeing some signs of outperformance? How about NVDA and its major event? Did it react with any kind of strength yesterday? The bullish gap was flushed, and it is never a good sign when we see stuff like that unfolding. So that's a little bit of a red flag, isn't it? You remember on Saturday's video I had featured a very extensive examination of where we stand in market breadth, judging from MACD summation index to new highs, new lows, advanced decline line, advanced decline volume, and as well various periods of moving averages and what's the percentage of stocks trading above them, because these metrics provide quite a few valuable signs as to where we are in this bottoming process, in this short squeeze Friday, and some kind of follow-through, risk on follow-through Monday that we have seen. Thank you for liking these videos and subscribing to the channel. Your likes and comments and everything help greatly. So, that's what we see today pre-market. Another day, second day in a row actually, with 90% advancing issues. Isn't it sounding a bit steep to you? Such is the retreat before the closing bell yesterday. We also saw quite some interest in selling by institutions in the closing, say, 15 minutes of the day, which is as well quite a sign. On the other hand, what everyone had been fearing, yen carry trade, Bank of Japan, policy normalization rates, no, this is going to be a non-event. We don't have to fear that. So I do think that we are going to be continuing in one distinct direction, possibly all the way to FOMC, which is already quite a clue that I'm giving you. Note as well, however, where are the different positions of those moving averages. The one on for 200-day moving average, which is bottommost, we are still below the 50 level. On the other hand, the uppermost, which is shown below the candlesticks part, that one had turned up steeply to the upside already. So, such is the sectoral view. Remember as well how Russell 2000 performed yesterday. You can see its reverse mirror here, kind of in real estate and consumer staples. So the defensive bias is there as discretionaries had been dragged lower by Tesla. Otherwise, back, it's not leading as convincingly as the run-up to NVDA events always used to be playing out like. So much for that 90% advanced decline and what could be interpreted as emerging cracks in the dam. Finally, my volatility metrics, the favorite 1 weeks to short-term weeks, we can see it calming down. Is it done, or is there more downside to come, or we will just return back to the steep rising kind of channel? VIX itself had continued deflating. Is there anything that can move it back up? Stay tuned for more updates. Thank you for liking the video and subscribing to the channel. My join page will help you select what's right for you based on what and how you trade. Always do combine daily analytics together with premium Telegram channels for the full coverage of everything that I do. Obligatory disclaimer, and talk soon.